Good morning. The underwriter's secret checklist, what mortgage lenders are really looking for. And when your mortgage application goes to underwriting, many borrowers assume that the underwriter simply just checks your credit score and your income. But there's actually a little bit more involved, and that's really just only the beginning. And behind the scenes, underwriters really have to follow a very detailed checklist designed to answer one critical question. And that question is this loan safe to approve? Do we have confidence in these folks? And understanding how the underwriters actually document and work towards that can dramatically improve your chances of getting approved and help structure your loan, your financing like a professional borrower. And as a mortgage broker with Medallion Mortgage and Medallion Funds, my role is often to prepare files that so that when they reach underwriting, they're just pass through smoothly through the system. And let's break down what underwriters are really looking for. And most of them are really on your side too, which is a cool thought. But the real goal of mortgage underwriting is that underwriters are there to evaluate the risk. And when you present it in a way that they're comfortable with, they can analyze your financial profile and the property itself to determine whether the loan meets the lending guidelines and whether the borrower is likely to repay the debt. And if you are, thumbs up. Most lenders evaluate files really using four pillars of underwriting, and these are the core ones: your credit, your income, your assets, and your property. And in any one of these areas has weaknesses, the underwriter may issue additional conditions so that they can feel comfortable declining or approving the loan. So, one is your credit profile. And your credit score is only the headline number. And underwriters will dig deeper into your credit rate report to evaluate patterns. And if you see a bunch of late payments that are happening very recently, that could be a problem. And they review your payment history, your outstanding debts, your credit utilization, your length of your credit history, any recent inquiries, and any really derogatory events on your credit. And for example, a borrower with a 720 score may have multiple late payments and be riskier than somebody with a 690 score and a perfect payment history. And underwriters care about behavior patterns and not just scores. So there is a little bit more than meets the eye. Two is your debt to income ratio, or DTI. And another key factor is DTI, and debt to income ratio is what that means. And this measures how much of your monthly income goes towards your debt obligations. So underwriters will evaluate whatever your proposed mortgage payment's going to be: your credit cards, your car loans, any student loans, any personal loans, any other real estate debt, and look at it from a combined basis. And most conventional loans prefer DTI to be below 43 to 45%, although exceptions can exist depending on compensating factors. And this is why strategic structuring before applying for a mortgage can make a huge difference. Three is income stability. So income verification is one of the most detailed parts of the underwriting. And underwriters will review documentation such as your W-2 forms, your pay stubs, your tax returns, your business tax returns if you're self-employed, but also your bank statements and any profit and loss statements and balance sheets if you're self-employed. And what they will also evaluate is your consistency and your stability. So, for example, have there been any recent job changes? Have you switched from a salary W-2 role to a commission income role? Do you have self-employment income? Is there some bonus income? And there's specific guideline requirements for each category is the point, and it's a matter of just documenting it proper. And this is where experienced mortgage brokers often help structure files to avoid unnecessary underwriting issues. So four is asset verification. And underwriters also verify that borrowers have sufficient liquid assets to be able to close the loan. So you would want to see the money for your down payment in your bank account ahead of time, simply put. But they're going to look for down payment funds, any closing cost reserves, or any cash reserves that you would have available after closing. And they review bank statements carefully to identify, say, large unexplained deposits, any gift fund transfers between accounts. And transparency is the key here. Large deposits need to be documented. We need to show where that money's coming from and if it's a stable source. Five is property evaluation. And finally, the property itself must qualify for the loan. So if there's a lot of holes in the sheetrock or something like that, it could be a problem. But underwriters also look at the appraisal value, the property condition, the marketability, as well as your title report, and is the insurance sufficient? And if the appraisal comes in low or the property has issues, the loan structure may need to be adjusted. So the secret sauce here is that structure beats rate. And one of the biggest misconceptions borrowers have is that mortgage approval is all about interest rates. And in reality, underwriting decisions are based on structure and risk management. And experienced mortgage brokers focus on, say, structuring loans properly from the beginning, making sure you're prepared and documented before you start, before you even get your approval letters, and basically matching borrowers with the right lending program. And this is why many borrowers choose to work with mortgage brokers instead of relying on a single bank source. And brokers often have access to hundreds of lenders and loan programs, which allows them to find solutions that traditional banks just may decline and not proceed. But here's the final thoughts for the day, is that mortgage underwriting isn't a mysterious process, and once you understand it and how the system works, you can structure appropriately. But underwriters are evaluating a structured checklist designed to answer one simple question. Is this loan safe for the lender? Does this make sense? Can they afford it? And when borrowers understand that process, you can prepare your finances accordingly and dramatically increase your chances of approval. And that's what I do here at Medallion Funds. And if you want to structure your loan the way professional investors and experienced borrowers do, working with an experienced mortgage broker can make the process significantly smoother. And that, my friends, is it for the day. Please visit billraponline.com to figure out how to get a hold of me. Love to talk to you more about whatever you're facing. Have a good day.